Good afternoon. Happy Friday, January the 20th. Mark Milam here, your mortgage professional with Highland Mortgage, coming to you with this week's interest rate summary and market update. Not a bad week for interest rates. Matter of fact, we got some excellent news.
Excellent.
On Wednesday of this week, the Fed's preferred measure of inflation, this is personal consumption expenditures, came in beneath expectations. That, coupled with the producer price index, how much it's costing us to produce goods and services, also came in beneath expectations. That just continues to add fuel to the fire that the worst of inflation is behind us. That's exactly what we want. We need inflation to come down. Of course, the Fed sticking to its rhetoric multiple times this week that they're going to keep rates higher for longer, so don't be surprised if on February the 1st at 2 p.m. Eastern Time, the Fed raises the Fed funds rate. Yet again, more than likely that hike is going to be smaller than previous hikes, especially towards the end of 2022. I would anticipate a quarter-point increase to the Fed funds rate, even though we're seeing month over month declines in inflation. The last thing the Fed wants to do is to get this wrong again. They got it wrong on the upside. They certainly don't want to get it wrong on the downside. And their worst case scenario, at least according to them, is a boomerang effect for inflation, where we see it moderate slightly, but then come roaring back in Q2, Q3 of 2023. They don't want that. But overall, great news on the inflation front and the interest rate front for this past week. Now, from our Make Your Blood Boil department.
No, God! No, God, please, no! 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 No!
We're going to shift our attention to the Federal Housing Finance Agency. This is the primary regulator for Fannie Mae and Freddie Mac, and believe it or not, they also have the power to alter your interest rate. Well, how do they do that? How can they alter your interest rate? Well, let me show you. There's something called loan level price adjustments. These have been around for years and years and years that apply to every single conforming conventional loan. This is your good old-fashioned 30-year fixed, 20-year fixed, 15-year fixed, even some ARMs in there. Most of the lending done in the United States is done under this umbrella, and these loans are underwritten to Fannie Mae, Freddie Mac standards. Well, they just announced a change to these loan level price adjustments yesterday, and let me show you what they did. I'm going to move over here to what we call the heat map, and this compares the old loan level price adjustments to the new loan level price adjustments. And if you fall with a credit score or a loan amount percentage into a bucket that's yellow or orange or red, your pricing for a mortgage just got worse.
What can I say except you're welcome?
Thanks to the federal government. So what they've decided to do in their infinite wisdom is to alter these loan level price adjustments to improve interest rates for who? For low credit score borrowers and minimum down payment borrowers. And listen, we're all about lending to the full spectrum of Americans, right? We want to ensure that everyone has the opportunity to own a home. But doing it on the backs of people who have saved for down payment and whose credit scores are maintained well seems like poor timing, right? The last thing we need right now is to worsen affordability for the majority of people who are looking to buy a home. Let me flip the screen back around and show you what I'm talking about. This is the Home Ownership Affordability Calculator or Affordability Monitor from the Atlanta Federal Reserve. And you can see right here, the affordability index is at 64.7%. That's almost an all-time low for affordability. Matter of fact, a reading of 100 means the average American family can afford the average priced or median priced American home. We are down at 64.7%. We have a huge affordability problem. Why do we have a huge affordability problem? Well, as I'm sure you're aware, interest rates have doubled in the past year. That's a big part of it. Also, home prices continue to go up. Why are home prices continuing to go up? Well, there's still a lack of inventory, and as long as there's a lack of inventory, we are likely to see home price appreciation, at least in most markets. Yes, there's some wage growth there, but that is like a Dixie cup trying to stop a tidal wave.
God damn it, I'd piss on a spark plug if I thought it'd do any good.
If there is just not enough wage increase to overcome these drivers negatively impacting affordability, and that's why we're at some of the lowest readings of all time. So this doesn't make sense that at one of the worst times in the history of the United States, the Federal Housing Finance Agency is choosing to do what? They're choosing to worsen affordability for the majority of Americans who've maintained their credit and saved for down payment. Certainly not welcome news from the Federal Housing Finance Agency yesterday. And this comes at a particularly bad time because it comes on the heels of Fannie Mae announcing their profitability for Q3 of 2022. Let's flip the screen around one more time. Here, Fannie Mae reporting net income, not gross income, net income of $2.4 billion for the third quarter of 2022. You read that right. $2.4 billion in net income for Fannie Mae for the third quarter of 2022 at the same time that most Americans are finding it hard to afford a median priced home, and now we're going to worsen affordability for those same Americans. This is a huge problem for the industry. It's a blight for this administration. It's something that needs to be reversed immediately. In the meantime, at least, we have seen some improving data on inflation. That is only going to go to help interest rates decline as we move throughout Q1 into Q2 of 2023. If I can be of any service to you over the weekend, don't hesitate to reach out, mark.milam@highlandmtg.com.